What are real estate investment trusts, and how could you use them to invest in the real estate market with very little capital? In this video, we'll go over what a real estate investment trust is and how to value a publicly traded REIT. So let's get right into it. A real estate investment trust, or REIT for short, is a company that solely invests in real estate. So basically they buy income producing. Now some of these REITs are publicly traded, which allow investors to invest in them as if they were purchasing a stock. So what do you get when you buy a REIT share? You get an ownership stake in all the properties that that REIT owns. Therefore, you get a piece of the income or losses that those properties produced. You receive that income in form of a dividend. REITs are required to pay at least 90% of their income out to shareholders in form of a dividend. The purpose of REITs is to allow investors to invest in the real estate market without having a large amount of capital. Think about it. If you want to buy a commercial building, you'll need to have hundreds of thousands, if not millions of dollars to purchase that commercial or residential building. Plus, they're going to have to go through the process of managing, maintaining, and finding tenants for the building. With a REIT, you can buy a small percentage of that building or have a small ownership stake in that building and receive the benefits of the income produced by that commercial or residential building. All right, so let's go ahead and value a publicly traded REIT. I went ahead and I pulled the financial data for Store Capital, a publicly traded REIT, and I placed it on an Excel file to go ahead and do a simple but effective valuation on this REIT. Now, to get the valuation, we're going to need the income statement, specifically the operating income, the balance sheet, and the current cap rates in the industry that the REIT is in. And we'll get to that a little bit more in a second. Let's go ahead and start in the income statement. These are the last 5 years of Store Capital's reported income statements that are filed with the SEC, going back to 2014. And what we want to do with the income statement is we want to find the net operating income and the net operating income's growth rate throughout the last, I'd say, 5 years. So by looking at the income statement, we can see that we have revenues, expenses, and then we have the net income at the bottom. But what we want to focus on is the net operating income, which takes the revenues and subtracts only operating expenses. Now, to do that, we're going to need to add back or remove some of the expenses that are not operational. In this case, it's going to be the interest paid and the depreciation and amortization on the properties. Both of those expenses are non-operational, and for this valuation, we want to get the operating income. So we go ahead and we add those two numbers back into the income, and we get the net operating income for the last 5 years. And I went ahead and I did some growth rates for each year in revenues, total expenses, and in net operating income. And I just projected 2019, what are some realistic numbers that Store Capital could hit. Now, these projections aren't anything too crazy. I just used prior year information and I made a conservative estimate for what 2019 could have. These numbers could be slightly off, which I'm sure they are, but they're just there to provide an estimate. So once we find the net operating income for the projected year, for the next year, in this case 2019, we can go ahead and take a look at the balance sheet. And for most REITs, you're going to have a few of the same items, which are going to be the properties and the land and improvements that they own, any land held for development, cash, receivables, and other assets. For Store Capital's balance sheet, they don't really have land for development, but they do have cash, other assets, and receivables. So you want to go ahead and add all those non-property assets, which include everything except the properties and land and improvement that's being rented currently. And the reason why we want to do that is because if we were to buy Store Capital, the full entire REIT, we would be getting those assets. And on the flip side, we also want to add all the liabilities. And we want to add all the liabilities because if we were to buy Store Capital, we would also take those liabilities with us, and we would need to pay those liabilities off. So therefore, we want to find the total liabilities to subtract it from our valuation. Next, we have the shares outstanding, and this is only just to get the valuation to a per share basis, which we'll get to in a second. Now, the valuation begins by taking the net operating income for the projected year. In this case, our projected year is 2019, and we came up with a projection of about $569,000. And we want to take the net operating income for the projected year and divide it by the current cap rates in the industry that the REIT is in. So different REITs invest in different types of properties. Some REITs invest mostly in commercial, others in retail, residential. For store capital, which is also listed on the 10K, you can see that they're primarily in the service and retail industry space. So I went ahead and pulled the current cap rates for those industries, which is at around 6.5%. And by dividing the net operating income by the current cap rate, you get the value of the properties owned by store capital. Next, we want to go ahead and add the non-property assets, because remember, when you buy store capital, you're also getting the non-property assets as well, which include the cash and receivables. But you want to also subtract the total liabilities or the debt that they have on that balance sheet. So we reach an intrinsic value of about 5.9 million, well actually billion, because these numbers are in thousands, and a per share price of around $29.10. Now, it's important to understand that this valuation is primarily based off the current cap rate and the current cap rate conditions. If you feel that this cap rate is a little bit too high or too low for the industry that the REIT is in, you can change this cap rate to get a better intrinsic value depending on what you believe the current cap rate is. You can get an idea of how the market is valuing the REIT by taking the share price that we got from the model and making it equal the current market share price by altering the current cap rate to get an idea of what the cap rate the REIT is trading in. And then you can compare that to the industry and see if it's a good investment or not. So that's pretty much the basics to real estate investment trusts and how to value one. Hope the video was helpful, and thanks for watching.